The White House has just told us
exactly how it wants to shape the crypto industry through a 160-page bombshell. This federal blueprint covers everything from how exchanges should be regulated to how everyday US banks might finally unlock total crypto access.
Unlocked.
So stay tuned, because today we'll translate the DC jargon into plain English, map out how this might shape crypto markets, and flag exactly what to look out for next. This is Guy, and you're watching The Coin Bureau. First up, I must make one thing clear. I am not a financial advisor, and nothing in this video should be considered financial or legal advice. This is purely educational content meant to inform you about crypto regulation. So if that sounds good, hit those like and subscribe buttons, smash that notification bell, and let's get into it. So then, what's the big crypto news coming out of Washington, DC? Well, it's a 160-page government playbook called, quote, Strengthening American Leadership in Digital Financial Technology. The report dropped on the 30th of July and comes straight from the President's Working Group on Digital Asset Markets. Now, we'll be showing you the most important details from it today, but if you'd rather have a look through the whole report yourself, you'll find a link to it in the description below. Just remember, it is literally 160 pages long. We read these things so you don't have to, my friends. Now, the tone of the report is positive right from the beginning. An accompanying fact sheet to the report claims the document will usher in a, quote, golden age of crypto. This is further evidence of the 180 from the previous administration's so-called choke point tactics to an overtly pro-crypto and pro-innovation stance. So, the first focus of the report was market structure. The White House Working Group calls for regulators to settle on definitions that everyone can agree on. By carving up the ecosystem into clear buckets, the report says agencies can end the guessing game that has driven innovation largely offshore. This may be ringing some bells if you're familiar with the Clarity Act, a bill focused on creating clear regulatory market structure for crypto. In fact, the Clarity Act gets a pretty hefty endorsement in this White House report. It flat out states that spot markets for non-security digital assets should be regulated by the CFTC, while anything that really is a security stays with the SEC. That's pretty much the biggest regulatory rule the Clarity Act aims to bring in. But in essence, this means the same coin won't be pulled from one exchange after another just because lawyers can't agree on how to label it. Projects will know from day one which rulebook applies, and exchanges will know whether they can list, stake, or margin that asset without risking a knock on the door from the regulator. But the report's authors don't stop at divvying up territory. They call for a unified federal crypto trading framework that lets a single platform offer a broad range of crypto and other regulated products, subject to regulator oversight. The idea is to avoid the so-called regulatory arbitrage by which platforms flip corporate structures or move servers just to avoid overlapping rules. For traders and investors, fewer licenses spread across fewer venues could translate into deeper liquidity pools, thinner spreads, and possibly even lower fees. Pretty good news overall. And self-custody gets a mention too. The report insists that any new framework must protect the right of Americans to hold their own wallet keys, directly in line with the ethos that kicked off this entire industry. That single clause could be the shield that both crypto natives and hardware wallet makers have been hoping for. It also sets the tone for the rest of the report, which is largely focused on banking rails and other rules around stablecoins. But as far as the report's focus on market structure goes, it was quite clearly an endorsement of the Clarity Act, currently up for revision in the Senate. Not totally surprising, but it might help improve Clarity's odds at becoming law. Now, for years, receiving an email from your bank inquiring about your crypto activity basically meant brace for a closed account. According to this White House report, that era for US citizens and businesses is coming to an end. In fact, the report includes a direct command for federal banking regulators to ditch the old choke point mindset and treat digital asset businesses and crypto holding individuals the same way they treat any other lawful customers. In practical terms, that means the White House is making things easier for the crypto industry to actually function day to day. Exchanges, stablecoin issuers, and crypto project teams should be able to wire dollars, park reserves, and open business credit lines without the constant fear of being debanked. The report goes further, though, telling the Fed to publish a transparent playbook for granting master account access to crypto-friendly banks and fintechs. Right now, only a handful of institutions can settle payments directly on the Fed's ledger through one of these so-called master accounts. Everyone else has to piggyback through a correspondent bank, increasing fees and delays. If the Fed follows through, on- and off-ramps for crypto could shrink from days to minutes or even seconds, and stablecoin redemptions would be as instant as swapping tokens on-chain. Bliss. Capital rules received some focus too. Instead of treating every digital asset exposure as toxic, TradFi supervisors are told to align capital charges with the actual risk of the specific coin, custody setup, or on-chain activity. It may sound like just basic common sense, but this is big. That nuance is a game changer for big banks that want to hold crypto on their balance sheets or issue tokenized deposits. The report even nudges regulators to set up sandboxes or safe harbors for market activity and calls for clarity so banks can participate in pilot programs. That lets TradFi experiment in controlled conditions before rolling out consumer-grade crypto products. But why should everyday crypto holders care about all of this? Well, more banks in the pool equals deeper liquidity, tighter spreads, and fewer emergency funds are stuck tweets when markets get spicy. Of course, the flip side to this is compliance. The same part of the report warns banks to bolt on robust AML and wallet screening tools before they touch blockchain assets. So expect more KYC if you're moving coins through a newly minted banking portal. Now, whether that trade-off is worth it is up for debate, but the report's clear support for self-custody shows that key pillars of crypto's ethos should remain intact. At least, that's the case for now. What's certainly worth it, however, is checking out the Coin Bureau deals page, because that's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on crypto exchanges. These deals won't be around for long, so take advantage of them ASAP using the link down below or the QR code on the screen. Now, as stated before, the report shows strong support for the Clarity Act and holds it up as a sensible option for crypto regulation. When it comes to stablecoins, however, the report explicitly states its support for the recently passed stablecoin bill, the Genius Act. The White House Working Group calls for officials to, quote, faithfully and expeditiously implement Genius. But beyond stressing the significance of the Genius Act, the White House report also dives into an exciting and expanding frontier for stablecoins: payments. The idea is to have a checkout system that automatically uses the best payment method, so merchants receive dollars without dealing with any cryptocurrency issues. As stated, the report also urges regulators to create pilot programs where firms can safely test blockchain-based tech. Now, this is mostly aimed at promoting stablecoin settlements and tokenized deposits. The focus is on interoperability between TradFi and crypto and solving the issue of isolated ecosystems. These pilots should ensure that legacy systems stay connected and consumers benefit from faster payments without needing to know that blockchain was involved at all. Then there's something that people in crypto have been sounding the alarm about for a long time: a Federal Reserve central bank digital currency, or CBDC. After some polite preambling, the report's authors repeatedly outlined the dangers of a CBDC. They warn that a state-run tokenized dollar could cannibalize deposits, throttle private innovation, and hand Big Brother a full view of everyone's spending. Instead, the report says the dollar's future lies in private token formats that keep the greenback's brand while letting competition sharpen fees and features. Their view is something akin to Apple letting third-party devs build apps while still owning the App Store. Which leads us to the last and perhaps most strategic point of stablecoins: defending US dollar dominance. It's no secret that US dollar supremacy has come into question recently, and the authors see stablecoins as a way to help maintain the dollar's global grip. Their playbook is simple. Make compliant dollar-pegged stablecoins so good, so liquid, and so cheap to move across borders that businesses and individuals see no reason to use any other currency. While leading stablecoins are backed one-to-one with either short-term US Treasuries or US dollars, the goal is to maintain America's lead amongst countries when it comes to stables. So, it isn't just about adoption, it's about absolutely cementing the dollar as the default unit of account on blockchain rails. Now, for everyday users, the downstream effect is less about buzzwords and more about experience. Imagine payroll hitting your wallet on Friday and landing as spend-ready dollars in your bank account before the bars close. Cross-border freelancers could bill in tokenized USD and spend or cash out locally without eating 5+% in foreign exchange fees. And in the same vein, the remittance industry stands to be further disrupted by stablecoins, and all with the explicit backing of the White House. And because the report keeps calling for transparency and proof of reserve audits, you may be able to do it all while checking that the stablecoin in your wallet really is backed one for one. Now, for most of the report, the tone towards crypto is resoundingly positive. However, that does shift slightly when the focus turns to illicit activity in crypto. Over 20 pages are devoted to cracking down on illegal activity tied to crypto, albeit while still aiming to protect legitimate activity. The report dives into a load of topics in relation to illicit crypto activity, including ransomware crews, sanctioned actors, illicit use of crypto mixers, and more. However, the report does place some emphasis on this being a small subsection of the market. All the same though, crypto's speed, borderlessness, and obfuscation tools make this bad sector punch above its weight. One of the report's main priorities is therefore to tighten and modernize AML and CFT measures. That's anti-money laundering and countering the financing of terrorism. Agencies are told to align with global standards and close loopholes that let non-compliant platforms court US users from abroad. And the report flags gaps in how rules apply across centralized exchanges, DeFi systems, and other access points. It then urges consistent, risk-based coverage so similar activities face similar obligations, regardless of the tech stack working behind the scenes. With respect to mixers such as Tornado Cash, the report's authors urge the Treasury to evaluate next steps on measures targeting such projects. While some have interpreted this as a warning sign, the report stresses the importance of finding a balance between cracking down on crime without hindering legitimate users. The report also backs more real-time public-private data sharing so investigators and compliance teams can coordinate responses faster. On the tools side, agencies are urged to enhance coordination on how digital asset risks are identified and managed, especially in fast-moving areas like DeFi. The White House calls for improved data sharing frameworks to help authorities detect illicit activity without defaulting to blanket restrictions that would harm legitimate users. One change everyday users will definitely notice from all this: tighter wallet screening across exchanges, stablecoin issuers, and possibly banks. The report pushes for broader use of blockchain surveillance tools to flag anything tied to mixers, ransomware wallets, or sanctioned addresses. That could technically mean more automated freezes and flagged deposits, even if the link is a few transactions apart. Potentially, this could have a significantly negative impact on the crypto user experience unless the tools for detecting illicit activity are incredibly accurate. Now, the report also looks at the legal tools used to recover crypto. It backs the idea of regulations that give exchanges or custodians more power to temporarily freeze suspicious funds while authorities investigate. This is all instead of pushing for a full overhaul of forfeiture laws. The focus here is to update existing laws so they work better with blockchain technology, without letting legal technicalities get in the way of recovering stolen or illicit funds. Internationally, meanwhile, the White House Working Group presses for the US to lead efforts in closing global loopholes, warning that uneven rules let bad actors exploit a global system. It also recommends giving the Treasury more power to block risky crypto transfers when needed. Sounds a bit like potential overstep, but what that would actually look like in practice is unclear at this point. For everyday US users, the takeaway here is simple though. More wallet screening, more flags on privacy tools, and more crypto-native compliance. The main trade-off here being more KYC in exchange for more security. Whether that's what crypto natives actually want is another hot topic of debate. However, it's important to remember that these legal questions primarily concern funds custodied by crypto firms, while the report seeks to firmly protect the right of self-custody. Okay, the final section of the report covers a major talking point under Trump's new pro-crypto regime: crypto taxes. The White House Working Group calls for modernizing tax guidance to reflect how crypto actually works, rather than trying to fit it into frameworks built for stocks and fiat currencies. One of the tax fixes the report recommends is an exemption for small crypto transactions. It urges the Treasury and Congress to clarify when low-value receipts, like staking rewards, airdrops, or small personal transfers, can be excluded from capital gains reporting. If lawmakers follow through, that $50 airdrop or grabbing a coffee with USDC would drop off citizens' tax returns instead of cluttering them with fractional gains and losses. Definitely something we'd all dearly love to see. The report also calls for revisiting exactly how staking, mining, and airdrop rewards are taxed. It urges the Treasury and the IRS to reconsider whether income should be recognized when rewards enter a wallet, or only when they are sold. And as we're talking about tax, it's no surprise that offshore exchanges are highlighted as a potential tax loophole. The report recommends new rules that would make US taxpayers report foreign crypto accounts, just as they do with overseas bank accounts. With respect to reporting, the working group backs syncing US tax rules with global standards, so exchanges everywhere send clean, compatible data that the IRS can actually use. The White House report also touches on tightening wash sale rules. Now, wash sales involve an individual selling crypto at a loss and buying it back soon after to claim a tax break, something that's explicitly banned with stocks. The report pushes to definitively close this potential loophole for actively traded crypto, but makes an exception for fully backed stablecoins. The working group's vision would implement a more practical tax regime. Small buys are exempt, staking isn't taxed until rewards are sold, and some glaring loopholes would be closed. For everyday users, that means simpler filings, but also fewer options for tax avoidance and evasion. Now, what this report makes clear is that the next year promises to turn these fresh directives into real-world catalysts. So, mark your calendars. While this White House report is technically just a policy blueprint, it reads more like marching orders. We've seen that Trump's administration isn't just nudging regulators towards crypto, it's pushing a pro-crypto regime hard and fast. The stablecoin question is largely settled. The Genius Act is now law, and agencies have their directives to begin implementing its measures. The bigger unknown is market structure, with the Clarity Act still in the Senate for potential adjustments. Draft changes concerning the definition of digital commodity or thresholds for security tokens could re-rate entire sectors overnight. That means we want to keep a close eye on committee schedules and vote chatter, as they are likely volatility triggers. Regulators, meanwhile, have been told to move swiftly to implement the White House's blueprint. In practice, that means Q4 is likely to bring more guidance and further favourable crypto-related actions from the SEC, CFTC, and banking agencies. Banking access is still tight for crypto firms, despite growing pressure to loosen it. Since 2022, it appears that the Fed hasn't approved a single master account out of dozens of applications from crypto-associated institutions. In fact, the one firm that previously had access, Reserve Trust, had its account revoked. Gaining direct Fedwire access would remove costly middlemen and speed up fiat ramps, so keep an eye on Fed dockets. Tax reforms are also on the agenda, but they won't arrive overnight. The report asks the Treasury and the IRS to act in various areas with respect to crypto taxation, but offers no firm timeline. Public signals suggest a draft may land in 2026, but until then, as unfortunate as it may be, current tax rules stand. One wildcard here, however, is the potential for the government to purchase more BTC for the US Bitcoin reserve. This was mentioned following Trump's original executive order that formed the White House working group behind this report. While the report offers no new detail and Treasury officials have been sidestepping questions, Axios reports that details are expected soon, citing senior administration officials. Now, needless to say, the US government actively purchasing BTC would in all likelihood blow the lid off the market, in a good way, so this is the element to which you should perhaps pay closest attention. But, all in all, this report is a hugely positive step forward for the crypto industry and for crypto holders in the US and elsewhere. Amazing how things can change, isn't it? Okay, if you got value from this breakdown, make sure to hit subscribe, ring that notification bell so you don't miss an update, and like the video as well for good measure. And if you want the full story on how the Clarity Act could finally settle the security versus commodity debate, you can watch our video on that right over here. That's all from me for today though. Thank you as ever for watching, and I'll see you next time. This is Guy, over and out.